Welcome to Stocks Simplified. Today, an ETF analysis of SYLD.
For decades, a single metric has defined the pursuit of reliable returns, the cash dividend. It's widely treated as a primary indicator of financial health and the standard method for returning wealth to shareholders. However, focusing strictly on that quarterly payout ignores a significant portion of corporate capital allocation. A dividend check represents only one of several ways a company can distribute value back to its investors. The Cambria Shareholder Yield ETF, ticker SYLD, uses a quantitative methodology to measure the absolute totality of cash a company returns to its investors. This metric, known as shareholder yield, identifies three specific channels for capital return: cash dividends, net share repurchases, and net debt reduction. The first pillar is the traditional cash payment. The second is the return of capital via share buybacks. When a company repurchases its own stock, it reduces the total number of outstanding shares, increasing the proportional ownership stake for remaining shareholders. The third pillar focuses on the balance sheet. By paying down outstanding debt, a company reduces its total liabilities. Retiring these obligations strengthens the firm's financial position and increases the underlying value of the equity. Evaluating any of these cash flows in isolation provides an incomplete picture of corporate strength. By assessing all three pillars simultaneously, the fund seeks companies with the highest potential for income and capital appreciation. SYLD is an actively managed fund, but its composition is dictated by a strict, rules-based quantitative algorithm. The process begins with a broad universe of US-based publicly listed companies. The algorithm first selects for those with a market capitalization over $1 billion and positive trailing 12-month net income. Next, the algorithm eliminates 80% of those companies, retaining only the top 20% based on their combined yield from dividends and net share buybacks. This emphasis on buybacks provides a specific structural advantage. Unlike cash dividends, which are generally taxable when paid, share buybacks allow a company to return capital without triggering an immediate taxable event for the investor. Once the high-yield candidates are identified, the algorithm applies further screens. It filters the remaining companies for value characteristics, quality metrics, and low financial leverage. The result is a concentrated portfolio of approximately 100 companies, selected for their ability to generate and return cash. This mechanical selection process is designed to ignore market sentiment, anchoring the portfolio to companies with established records of capital distribution. The fund maintains this active rotation with an expense ratio of 0.59%. The criteria for high shareholder yield naturally results in a portfolio heavily weighted toward industrial and value-oriented sectors. This chart displays the valuation of SYLD relative to the broader market. The fund's price-to-earnings ratio is 11.87, while the S&P 500 stands at 25.79. The same trend appears in the price-to-cash flow ratios. SYLD is priced at 6.57 times cash flow, compared to 18.35 for the S&P 500. These metrics drive the fund into specific sector concentrations. Currently, the portfolio holds a 24.8% allocation in consumer discretionary and 21.9% in financials. The energy sector makes up 18.1% of the portfolio. This represents a 14.1% overweight compared to the standard S&P 500 indexed. By prioritizing capital return and low leverage, the methodology builds a portfolio that diverges significantly from tech-heavy market indexes. There are clear advantages to this approach. Selecting for debt reduction naturally builds a portfolio of companies with lower leverage and stronger balance sheets. This strategy has resulted in a 4-star, 10-year Morningstar rating for risk-adjusted returns within the mid-cap value category. However, the very same strict quantitative rules that drive outperformance for the fund also introduce their own specific risks. The most prominent risk is sector concentration. By following yield, the algorithm creates significant exposure to specific areas. With nearly a quarter of the fund in consumer discretionary stocks, it's sensitive to consumer spending shifts. A downturn affects a large portion of holdings. The strategy captures value by accepting a higher reliance on cyclical economic conditions. In summary, SYLD offers a holistic and tax-efficient alternative to traditional dividend funds, trading at a lower valuation than the broader market. Conversely, its divergence from the main indexes means it does not capture the growth of the technology sector and carries concentrated cyclical risk. Does the three-dimensional shareholder yield algorithm offer a more complete approach to income, or does its sector concentration make it too volatile for a core holding? Share your thoughts on SYLD in the comments and subscribe for more analyses of investment methodologies. This video is for educational purposes only and does not constitute financial advice. Investing involves risk of loss, and you should consult a professional before making investment decisions. Understanding the true market requires looking beyond surface-level payouts to examine how companies manage and distribute their capital.